All right, welcome back to the Anomaly Angle. It is Friday, so that's Wellness Friday. A couple of shots for the boys here.
Here we go.
Turmeric shots to make sure we make this tax episode semi-interesting for you. All right, it could be good, it could be bad, I don't know, but
Wellness life.
today we're gonna talk about some foundational items. We're gonna talk about entity structuring. There's a lot of information out there on entity structuring, and oftentimes we see people jump into entities a little too quickly, maybe choose the wrong one. So we talked last episode, if you wanna go back to that episode, about S Corps. Well, today we're gonna talk about what are the different scenarios that happen when someone's forming a business or in business, and where should your head go to, right? The basic word of caution here before we get into it is pump the brakes. Don't rush this part of it because it's hard to change and hard to go back. So John, to get started here, let's start at the foundation level. What's the first kind of item we'll talk about?
Yeah, I think it's probably the most overlooked one, which is just being a sole proprietor, right? Like having no entity. And I think there is a place for that. It's a thin circumstance, but when you're just starting out and you're kind of proof of concept, maybe you're starting out in an operating business, you have limited capital, you don't want to spend a lot of money getting going, it's perfectly fine to just essentially hang your shingle and go after it and try to drum up business or start your journey that way. From a tax perspective, it's perfectly fine to do that. And you're going to eliminate a lot of the expenditures that are associated with, starting an entity and those sorts of things. There's certainly drawbacks to that, which are, you're completely exposed personally if something were to go wrong, if you were to get sued, or if the business were to go south. So that's why at some point there needs to be, when you have mass and you have more exposure as the business grows, that we need to get into an entity. But I still think it's something that is valid if you want to be nimble, quick, and kind of start something up.
Yeah, and one of the common things we hear from people that's just wrong is that, well, I need to set up the LLC so I can get tax deductions, right? So if you remember anything from this episode, remember this: an LLC has nothing, 0.0 to do with tax deductions. LLCs don't even appear in the tax code. So an LLC is a state mechanism to form an entity. The IRS, or the tax code, really defines it differently, right? So if you just set up a single member LLC, or as John's saying, you're just a sole proprietor, it's the same thing. You're considered what we call a DRE, or disregarded entity. It just means that, hey, this is just an activity that goes on your personal tax return, Schedule C, as a sole proprietor, right? Schedule C says sole proprietor. That's where you're reporting your income. So we often tell people that are like testing the waters, side business, an online side business they're starting, maybe their kids are starting a business, right? Hey, just to test it out, to see if it works, see if you get any traction, you can go on irs.gov and get an employer identification number as a sole proprietor. Another misconception is, oh, I need an LLC to get my tax ID. No, you can get your tax ID number as a sole proprietor. It's literally free. So if you're just testing it out, trying it out, there's nothing wrong with, don't be scared of a sole proprietorship. More likely than not, you're probably not doing something so risky you're gonna get sued in a couple of weeks. Right. So before you go and spend the money to get incorporated or go LLC and hire lawyers, sole proprietor is completely fine. Remember, there's no tax benefits of an entity that's an LLC versus just a sole proprietor. If it's just you, it's the same thing.
Totally, yeah. So put a bow on that. The scenarios that we would recommend for a sole proprietor are really, you're just starting out, you're not sure about where this is going to go. You don't think it may not be long-term. It might just be something short-term. And it's something that there's not a lot of liability around. And that's when it's like, okay, let's operate like this and see where it goes. And then the next step, which Greg kind of already alluded to, and maybe it depends on what you're actually doing, but the next subject would be LLC, the limited liability company. And that is the common misnomer is, if you are just a single member LLC, you're going to be taxed the same way had you even not had an LLC. It's the same exact thing. The reason why you would step into a single member LLC is purely for that liability reason. You want to have that asset protection. You want to put that bucket around your business. And, there's a lot more, in terms of recognition and kind of and notoriety around the fact that you have an actual LLC, actual business. It's not just you personally. So those would be kind of the two reasons where you would move into that. Operations are kind of scaling up, and then you want to put a business around what you're.
Yeah, the second thing you're going to want to know about an LLC, again, if you just form an LLC, it's just you're considered a disregarded entity. From the IRS's purposes, if you are sole proprietor, John Malone, single member LLC, it's the same, right? There's no difference. However, having an LLC around you does allow you to make certain elections that you otherwise cannot make as a sole proprietor. For example, if you eventually want to be taxed as an S corporation, even taxed as a C corporation, you need the LLC first. So it's impossible. You cannot go from sole prop into an S Corp. You have to take an intermediary step. You need to go sole prop to LLC to S Corp, or even technically sole prop to C Corp to S Corp, right? So remember, you can't jump those lines. Second, if you go back to our S Corpus episode, there's the concept of a retroactive S Corp election. In order to do that, you must plant your flag with the LLC formation date, or technically the corporate formation date as well, not your sole proprietor or sole proprietor start date, I should say. So just be aware of that. That's a little bit of a nuance there. The LLC has that benefit as you are planting your flag on the moon saying, hey, this is when my business is formally registered, and it allows you potentially to do some other things later on. But by default, single member LLC, sole proprietorship, no differences from a tax reporting, tax benefits, and yes, tax deduction standpoint. So all those people on TikTok tax that are saying, pay $100 for LLC here to write off your car, like, it's a lie. You don't need the LLC.
Right. Yeah. And I think the one thing too, to maybe help people separate it in their brains, is an LLC is a legal entity, right? So that's something you form with the state, and that is a legal concept. And what's good about an LLC is it's flexible. You can be taxed in a number of different ways. So like when you hear S Corp or C Corp, or people say, I'm an S Corp or I'm a C Corp, that doesn't tell us what your legal entity is. So an LLC can be taxed as an S Corp, like Greg said, or it can be taxed as a C Corp. It also can be taxed as a disregarded entity and just flow to your personal return. And we'll talk in a moment how it could be taxed as a partnership too. So that's an important distinction, is like the legal entity and how it's taxed, right? S Corp, C Corp, the partnership, those terms are tax statuses. That's an important distinction. So when we move on from, okay, now you're a single member LLC. Now the decision tree there is, if we're going to be kind of in tune with our last episode, is if you're going to be a profitable business, and you can check out that episode about kind of the whys and wherefores of an S Corp. But if you're going to be a profitable cash flowing business that you're going to run and operate, an S Corp could be a good structure for you. You see a lot of professional service firms that are S Corps, same owners that are driving high cash flow. It's a good structure for that. And generally they are LLCs taxed as S Corp. Now, if you're an LLC, just say you're an LLC, me and you start an LLC, it's a multi-member LLC. How does that tax?
So two people come together, right, and they have an LLC. The default is going to be, you're going to be taxed as a partnership. So partnership, separate section of the tax code. In partnership tax law, I learned a long time ago, if you really love rules, become a corporation. If you really don't like rules, become a partnership. Why? Super flexible part of the tax code. Ultimately, everything is going to get flowed through and taxed at the personal level. So it's a holding bucket per se, where items of income loss, deduction, gains, credits, etc. get allocated. They run through certain mechanisms in what's called an operating agreement. So a partnership has an operating agreement. It's the legal binding document of how we do business together. That must be followed, and items of that will follow and flow through to you on your personal tax return. So becoming a partnership does not give you a different tax rate per se. At the end of the day, you kind of are just taxed like you would be as a sole proprietor. There's some nuances there, right? For the accountants watching, of course. For the most part, the items are going to flow through to you, and you're going to be taxed at your personal tax rates. You are going to be subject to self-employment taxes. You're going to be subject to income taxes as well. But the nice thing about a partnership is you can have flexible agreements between you, so long as they meet certain rules. And that item, right, is going to come, you don't have to worry about the entity level tax at the federal level. They're going to come flow through to you as a partnership. So partnerships can be great. The tax burden is not always great, but it's not always about the tax burden.
Yeah. So LLC, obviously the big takeaway from an LLC is it's probably the most common legal entity type that we see, because of the flexibility, right? You can kind of pivot in certain circumstances depending on how the business goes. But I'll run you through a couple scenarios, Greg, just each LLC kind of tax status and what type of business generally fits in this bucket. So starting off, like LLC single member disregarded, what do we generally see in that?
Disregarded and single member LLC, it's generally what we call like the side hustle business. It's going to be your startup that's just like testing the waters. It's going to go on your personal tax return. It could be like a side family business. That being said, we've seen some very large businesses on a Schedule C. The tax and maybe political nerds out there, the President Trump's tax returns were leaked many years ago, illegally leaked. They came out and they were like kind of amazed to me. there's like 100 Schedule Cs on that thing, right? Which are again, single member LLCs. And is that like a bad thing? No, not necessarily. It's just all reported on your personal tax return. And generally, the larger you are, most people are moving past that structure. It doesn't mean it's wrong, right? Some of these businesses have losses. Some of these businesses are smaller, but it's typically the smaller business starting up, sole owner, testing the waters, or not super high revenue at that point.
Yeah.
But that's generally what we would see.
Yep, totally. And sometimes, like, there's other instances where it's like maybe it's holding a property, and there's the whole real estate side of it too. That will be a single member LLC. All right, how about, I kind of alluded to this, but like LLC Tax as an S Corp and LLC Tax as a partnership. What generally
LLC Tax as an S Corp, most likely you're going to see service-based. So think of like B2B, or could be B2C, but services. It's going to be likely 2 or less owners, so 1 or 2 shareholders, I would say, in an S Corp situation, that have a relatively high profit. So think $100,000 profit or greater. That's kind of where the S Corp is going to make the most sense. Beyond that, right, when you have multiple owners, it's not the best situation. And again, go back to our S Corp episode for the in-depth part of this. But a lot of time we don't see that like product businesses are the best, because product businesses are typically financed through debt or maybe through equity. And there's some nuanced rules within S Corps that might make that not favorable. So service-based businesses with very few owners is typically going to be the best S Corp scenario. And then second part of your question, partnerships. Partnerships are generally going to be best for multiple members in a partnership, shareholders in S Corp. So multiple members in a partnership. And again, likely to be service-based, doesn't have to be. It could be a real estate partnership, it might be a service partnership, but you're gonna have many people and there might be more flexible arrangements between the people, right? So you'll see often like the major accounting firms, the major law firms of the world, the major marketing agencies, usually are partnerships because they're able to allocate items specifically to partners or to members based on what their agreement is that you otherwise could not do in an S Corp. And then there's some twists to this, right? There might be multi-tiered entities that come off of a partnership, whether in real estate or in service businesses, but you're going to see that's the most likely scenario here is a real estate based partnership, right? You'll never see real estate in S Corp that's appreciating, or you're going to see a service based partnership with many partners, right? If you have a 2-person partnership and that's what it's going to be forever, there's probably some structuring work you can do to make that a little bit more efficient. But when you have 3, 4, 5, 6, 20, 30, 200, 5,000 partners, you're going to be a partnership.
Yeah, totally. And then this can segue into our next topic. We don't really see this that much, and most people probably don't even know, but an LLC can be taxed as a C Corp. Is there really any like scenario where it's like
so tax law changes, all the time, and it was popular way back, and then it became less popular, and then post TCJA and extended to OBBB, there's been some more talk about C Corp. So C Corps again have their own tax rate, 21%. So if you're an LLC, you can be taxed as a corporation, right? So you can say, hey, I'm an LLC, and that's my legal structure, but hey, IRS, do you mind taxing me as a C Corp? And I fall under the corporate tax code versus the LLC partnership or disregarded tax code. So you can do that. The problem is that 21% tax on earnings. And then if you take money out beyond those earnings, you're either going to pay a dividend tax, which could be about 23%, or you're going to take money out as a wage, which is another between 20 and 37%, depending on what your personal tax rate is. So when you add those two items together, you don't get things like the QBI deduction. Your effective net effective rate plus state taxes is likely, not guaranteed, but is likely going to be higher than if you were an S Corp or just to flow through partnership. So you don't see it as much. If you wanted to be a C Corp for non-tax purposes, you're probably going to be a C corporation, right? Meaning you're a corporation at the Delaware, Massachusetts, Rhode Island level. You're not an LLC taxed as a C Corp. See the difference? I'm a C Corp taxed by default as a C Corp versus I'm an LLC. I just want to be taxed as a C Corp. You don't see that as much anymore. There are some very niche situations where that does make sense. But for the masses, if you're starting an LLC, I would say it's rare. If you're an LLC and someone tells you you should be taxed as a C Corp, I would push back on that and say, was it better than I'm just a C Corp as an entity versus an LLC choosing to be taxed as a C Corp?
Yeah, that's a good point. And that we can talk about corporations now, because when you
the rule followers.
Yes. When you go and you decide, hey, I'm going to be a corporation, the default tax status is you are taxed as a C Corp.
Correct.
You also could be taxed as an S Corp. We do see that here and there. And the distinction on the legal side is a limited liability company, just the governance is the same, right? You have an operating agreement. There's members that are owners. It can be manager managed, which is like the managers. And then a corporation, when you form a corporation, this is when you're dealing with, okay, board of directors, officers, shareholders. Like that's the legal difference. And that's the difference that you will see in like the actual governance of those entities. But there's overlap on the tax side. So what Greg's saying is, okay, if you're like, hey, we're gonna be taxed as a C Corp, like more often than not, like 90+% of the time, you're just going to be a corporation because that is the intent of what you're doing.
Well, and where it gets gnarly, right? So like most businesses become C Corps because they want to raise equity. So they want to finance their balance sheet through the equity section. So we're going to bring on shareholders, right? Now, if you're an LLC taxed to C corporation, that gets a little weird because you're actually an LLC. So what are you really giving out? You're giving out membership units, but you're taxed as a C corp. So like, there's often these like struggles between lawyers and accountants. Like, well, what is really even happening here?
To be honest, it's people are looking at each other like,
people get very confused. And private equity or venture capital firm are not going to buy into your LLC taxed as a C corporation. They ain't going to do it. Trust me. We've been through it. What they're going to do is say, that's cool. Head over to the Secretary of State's office and file those articles of conversion because they're not going to invest into that LLC. So again, the legal mechanism gets a little wonky there. So most corporations that are actually corporations, large companies, right? Why? Because they're either publicly traded or they have a lot of shareholders, right? Because they're selling stock in their company to raise money. Are we going to see one or two shareholder C Corps? Again, it's not frequent. You can see it. It's not frequent though, because if it's a one or two person C Corp, likely it's a business that they're holding and operating for the long term. One would question, well, if they're holding for the long term and they're generating high profit, is that the most advantageous position for them? Maybe, but probably not.
Yeah. And like we said, C Corps, corporations, C Corps, what you generally see is companies that are raising capital, they're fundraising frequently, rounds of raises, ultimately looking for an exit. We've talked in other episodes about the advantages of exiting in a C Corp structure with qualified small business stock and Section 1202. But that is what we're doing. Like obviously all the tech companies, any company that's raising money, like you need to be in a corporation taxed as a C Corp. It's a no-brainer. Corporations taxed as an S Corp, like I said, is more fewer and further between. You'll see some law firms, generally like older law firms before LLCs really became a thing.
That's exactly right.
Corporations, they're taxed as S Corps. It's not a bad thing. You have that kind of body of, there's a lot of corporate law, that kind of defends, the governance of corporations. So you see a lot of like older school law firms, professional services that are.
Or just businesses that were formed in the 70s, right? Or legacy businesses that there wasn't an LLC. So it was a C Corp, then Subchapter S came out and they went into Subchapter S at that point. But the underlying mechanism. Now, the last thing we'll say on this is that, and this is probably beyond the scope of today, there's differences on liquidation between an LLC tax and S, a corporation tax and S Corp, a corporation tax and corporation. Like the end is a lot different and messy between those situations. Sometimes it's out of your control, right? Those businesses that we see these sometimes like, why do they do this? Or why are they set up this way? Why are they an underlying corporation? Because they're so old, right? That's the business had been around well before I was born. And it's hard to judge something it wasn't in law at that point. So sometimes it is what it is, and there's some nifty ways to fix it later. But you do see that sometimes.
Yeah, totally. The end all be all is there is multiple different ways that you can go, and everything is like, I don't think there's necessarily a bright line test for every single bucket. But the important thing is that, you need to understand like where your vision is, what you're looking to do, and then talk to your advisor about it, whether it's your lawyer, CPA, your tax professional. Those should be your guiding lights based on what you want to do and what you've done to this point as to where you should go with your entity structure, because it is going to drive the ship on your tax efficiency.
Yeah. Well, there's a lot of different ways to skin the cat here, and hopefully this provides a little value to you if you're getting started or you're questioning what your entity structure is. So if you have questions, drop them in the comments, reach out to us here at Anomaly. We're happy to help. Otherwise, we'll talk to you on the next episode of the Anomaly Angle.
See you next time.